Advancements in technology means there is a new demand for rare earth materials, but with so many mining companies in the world, it's hard to know where to start. Well, I've done the work and I've got a strategy. Grab your pickaxe. It's time to go mining. Apologies for the delay since my last video. I've been quite busy upgrading my system, getting some new sound equipment set up, such as this microphone, also I can bring you the better quality that you deserve.
Yourself.
In this episode, I've been looking into the mining industry, digging through the financials to bring you 3 companies that I think are worth investing in, and of course I'll be investing myself and explaining why. Now, climate change has been a concern for many years, but it's only in the more recent years that governments have been pushing solutions and agreeing to deadlines to bring greenhouse emissions down to set levels. The very recent climate report from the IPCC has given a code red warning that the 1.5 Celsius warming target will be breached without immediate, rapid and large-scale reductions in greenhouse gas emissions. So the push away from fossil fuels has never been tougher, and that means there is going to be a significant change and demand for the materials necessary to bring this to fruition. That's where mining companies come in, and why I think now is the time to stop building a position. And my main focus is going to be around the motor industry, as this seems to be an issue at the forefront of climate change issues and the way that technology is evolving. The UK and EU have been moving forward targets for EV dominance, and recently the Biden administration announced that they would be raising mileage and emission standards to push the country into a 50% electrical vehicle status by 2030. This is also a social and economic issue where customers are demanding a more climate-friendly alternative to carbon fuels, but also need the industry to become more economical, with the prices coming down to more reasonable levels. There is also a millennial demand for more advanced technology in cars, not just phone syncing and GPS, but smart safety features such as self-parking and self-driving amongst others. This means more tech, more components and more materials. Now, the types of materials in demand 20 years ago have changed to modern, rarer and more expensive materials. Back in the day, older cars had more basic materials, such as rare materials being limited to sections such as catalytic converters and spark plugs. The change in material ratios in more modern vehicles has caused the industry to lag behind, as the supply chain still needs to be figured out. Now, an article in the Journal of Industrial Ecology highlights the differences in materials for electrics, plug-in hybrids and combustion engine vehicles, as in this chart. Now, the fuel cell market is developing fast, and there are differing reports on its potential, but generally speaking, the market is expected to reach $15 to $33 billion by 2027, representing an annual growth of up to 15.5%. So it is worth stepping into the industry. So let's talk about the fundamental materials needed. Now, the batteries need mainly lithium, nickel and cobalt. And research from Bloomberg is pointing towards copper and nickel demand for batteries increasing by over 500% over the next 10 years, with manganese, which is essential in the production of steel and batteries, and also an ingredient in dog food, expecting to grow over 900%. And the demand for more power out of fewer cells means that there is a general push to more densely packed builds, which means more material per unit size. There's also a demand for more speculative solid-state batteries for a lighter, safer and more efficient option, which again rely on different material builds. Now, the magnets in electric motors require rare earth materials such as neodymium and dysprosium, and they make up the majority of motor cost. Plus, this technology also means more semiconductor components, which requires silicon, germanium, diamond, boron, aluminium, zinc. Honestly, the list just goes on. And all these components need gold for contacts and also an element to connect it all together.
Wire.
copper.
It's also not so simple as just finding the biggest resource and companies to mine. Cobalt, for example, has some famously questionable mining practices, with its resources being confined to China and the Democratic Republic of Congo, where the political situation is problematic at best. Poor mining practices, particularly when incidents happen, can have devastating effects on the area and the reputation of the company, and therefore stock price. Shortcuts may increase profits in the short term, but when a disaster strikes, the consequences can be immense and long term. Rio Tinto made an error last year when they destroyed several cave structures that represented evidence of a 46,000-year-old civilization, angering Australia and causing their CEO to step down. Now, I would question exactly what ethics the remaining board have to have allowed this to happen in the first place. Also, China have been able to produce steel cheaply using government subsidies and have used this to undercut the global market, which in 2012 damaged Russian, Ukrainian and British companies. In 2020, 62% of their iron ore came from Australia, accounting for 40% of Australia's exports to the country. Due to degrading relations between the two countries, China are developing an alternative source in Guinea, West Africa, where through ChinaCo they own 39.95% of the Senandu project to Rio's 45% and the government of Guinea's 15%. This is likely to hurt Australia's mining economy, specifically BHP Billiton. You can also look at the most recent activity in Afghanistan, where the Taliban look to be in control of a country rich in the resources we've discussed, valued around $1 to $3 trillion. But the volatility in the country has prevented the mining opportunities from being developed in the past, and unfortunately it's likely that any such development would be exploited by warlords, armed militias and the Taliban themselves. China was quick to claim they want friendly cooperation with the Taliban, but I wonder if that is achievable given their treatment and animosity towards the Uyghur populations in China and those the Taliban support. Another thing is that mining companies tend to be based all around the world, and their location determines which currency they trade in, meaning that we have to factor in the political and social economic situations which can affect the exchange rates and the long-term potential of these companies. Now here's a quick rundown of the rates over the last 5 years that shows that due to inflation the American dollar has weakened against our glorious pound sterling. As always, I've started my search by studying the fundamentals of various mining companies, then I filtered them down by various metrics. The current and forward price to earning ratios, the price to book and price to sales, the EBITDA, the enterprise value to EBITDA. This narrows it down to the list of companies that fit my investment criteria. Then I've collected the production data of these companies to compare them. To start with, here's a summary of the production data I've gathered so far. Yes, it's a lot of information to go through, but I've already gone over the financials, meaning I can narrow it down even further to the top companies offering the most value and growth opportunities, which means I can present this chart which shows those top companies based on the last 4-quarter production reports. Now the data shows that none of these companies is going to give me the best exposure to every material, so it's an issue of either picking the most valuable materials or selecting multiple companies to maximize my exposure. Anglo American, Impala Platinum and Sibanye Stillwater are offering the greatest exposure to platinum group metals, with Anglo in particular offering some massive manganese exposure. BHP Billiton, who operate in Australia, are taking the lead on copper production, with Arizona's Freeport-McMoRan just behind. Vale appears to be the most diversified out of the group, but their competitor Rio Tinto beats them on iron and copper production, with Anglo and FCX beating them both on copper production. What the data shows is that production from these is generally on the increase, aside from manganese and gold, which have come down. Having gone over all the production and financial data for these companies, it is my belief that the best investment opportunities are with Sibanye-Stillwater, Vale and Anglo American. Here's why. Sibanye-Stillwater are one of the top 4 private sector employers in South Africa, operating mining sites there and in the USA. Now, since 2013, they've started building a diversified mining portfolio, starting with gold, where they've made huge returns as the value surged to an all-time high. Additionally, they own 50.1% of DRD Gold, which boosts their gold portfolio even further. In 2016, they extended into platinum group metals, which are vital components of fuel cell technologies and have grown significantly in value. They are currently the 3rd biggest PGM producer in the world, against their fellow South African competitors Anglo American and Impala Platinum. This graph shows that from a production standpoint, Sibanye are growing substantially, whereas the others appear to be slowing down. Since 2020, they have focused on increasing their exposure to lithium, hydrogen and cobalt production due to the increasing relevance in advancing technology and the movement towards fuel cell and hydrogen-based vehicles, space industry and advanced medical equipment. According to Bloomberg NEF's Lithium Outlook, there is enough lithium resources available in the world, but it's the mining industry that needs to catch up. This is where Sibanye are moving to take advantage of the opportunity, implementing their battery metal strategy with 2 initial steps. The first step, in February this year, they spent €30 million for a 30% stake in the Kaliber project, which is focused on meeting the demands of the growing lithium market through their €313 million project based in various sites in Finland, where they anticipate to have 13 years of operation. They claim to have one of the most cost-effective extraction methods and expect to produce 15,000 tons of battery-grade lithium hydroxide. Production is due to start in 2024. The second step, by year end, Sibanye expect to complete the purchase of Sandouville nickel refinery from the French company Eramet for $77 million, which offers an annual production capacity of 12,000 tons of high-quality nickel, 4,000 tons of nickel salt and 600 tons of cobalt chloride. This gives Sibanye a low-risk entry into the European battery metals platform. I think the diversification of their metal productions was a good move, because whereas gold production and demand may be cooling off, platinum group metals are developing more demand for a long-term price increase, making Sibanye a stronger and more relevant company now and for the long-term future. And that brings us to the financials. Now, with the financials, I've set up a chart to reflect the earnings against other companies in the PGM sector, as that's the area I'm looking to fill. Now, going through the company's latest earnings, revenue has been increasing year on year, and it looks like they are catching up with Anglo American and Barrick Gold, likely to overtake them in 2021. Costs, profits and EBITDA match the pattern, and the first quarter of this year reported a 78% higher adjusted EBITDA than 2020, a group record. Additionally, they have moved from a negative earnings per share to a positive $2.58, reflecting a 42,883% increase from 2019, which is outstanding growth compared to the competition. Assets have also grown year on year, and they are steady, although I'm impressed with the asset build-up from Anglo American, so more on that later. Cash and equivalents have grown massively, up 260%, and equity up 127%, with liabilities down by 9% and debt 26%, with their debt to equity ratio at an all-time low. They appear to have been issuing shares on a small scale, but overall I'm impressed with the health of the company. Additionally, they resumed their dividends in September last year after a 2-year gap, and they paid another dividend in March this year. So with dividends matching their 6-month 4-quarter returns, another may be due this September. Overall, the fundamentals look really solid, and although some production plans aren't going to be taking place for a number of years, with profits to follow, their returns over the last year show that they have decent growth and earnings potential. But, and perhaps a big but, the stock has had some volatility lately due to the political situation in South Africa, where the country sentenced the former President Jacob Zuma to a 15-month jail term for corruption, where he was allowing Indian businessmen to plunder state resources and influence government policy. The country is experiencing riots, looting, and with the police unable to resist the numbers against them, the army has had to be called in to deal with it. The situation is disrupting supply chains of retail and medical supplies, particularly the coronavirus vaccination drive. There could be some real issues if miners refused or couldn't return to work out of protest, with mining representing 8.2% of the country's GDP in 2020. So there is a close link to the economy of the country, thereby affecting the currency exchange with sales and earnings. It could potentially be a value trap for investors who jump in too heavily at the wrong time. However, the materials in South Africa aren't going anywhere, so whatever happens with the political climate, Sibanye is in a strong position to be around when the dust settles. So Sibanye-Stillwater gives us a gold and platinum group metal exposure, and also exposure for cobalt and lithium in the future. So that leaves us looking for copper, nickel, iron and manganese production, and that's where my next stock comes in, Vale. Vale is the most valuable company in Latin America and operates in 26 countries and are the largest producer of iron ore and nickel in the world. However, they are still recovering from some tragic events. Vale, along with BHP Billiton, were involved in the Mariana Dam disaster in 2015, which devastated villages and killed 19 people. The following year, 21 executives had manslaughter and environmental damage charges against them due to a 2013 report that indicated they were aware of structural weaknesses in the dam. The companies agreed to pay billions in compensation, and of course the financials and stock took a hit. Then in January 2019, a dam that Vale operated in Brazil collapsed, releasing a mud flow that blasted through the site offices, with many workers in the cafeteria locations. The BBC reported that the warning system in place did not go off, and 270 people lost their lives, of which 11 bodies were never found. Vale saw a fall in their stock price of 24%, costing them $19 billion in market cap, and they had to cut their dividend. The 2015 case was frozen in 2018 after a compensation agreement was made, but this seems to be floating around the courts as of last year, with accusations that the companies are not meeting their obligations in a timely manner. The 2019 disaster, however, has been settled as of February this year after Vale paid $7 billion in compensation to the families of the victims. Still, the company's reputation has taken a hit, and they had to restrict operations at several sites such as in Timber, while safety checks were carried out and the company faced delays in permit grants. This left the door wide open for their main competitor, Rio Tinto, to take the lead in iron ore production last year. Since then, the company has been gradually rebuilding their reputation and claims to be improving safety at their sites through new safety implementations and changes to their management structures, along with a bonus structure that has been altered to put an emphasis on health and safety and risk management. Moody's Investors Service and Fitch Ratings both agree that the company has lowered their credit risk through significant advancements in their safety practices. Which brings us to the financials.
Drumline, hit it!
Now to start with, here is the production data for Vale, which shows that despite a drop in manganese production, despite the pandemic, these figures are relatively stable. However, if we take a look at the global positioning of their metals, we can see that their main location, Brazil, is just third by way of nickel production, with Indonesia and Australia holding a significant advantage. However, if we look at the companies who operate in Australia, BHP is producing half the amount of nickel, whereas Rio Tinto isn't producing any. Now, Vale's iron production is meeting their 2021 expectation with 330 million tonnes, and they expect to reach 350 million tonnes by year end, and they are estimating 400 million tonnes by 2022. As for the finances, if we look at the revenue, BHP and Rio Tinto hold the top lines here, with Anglo catching up sharply. Vale is also increasing on a smaller scale. But if we flip this to the growth percentages, we can see that Anglo American and Vale are showing the best year-on-year growth for these sections. BHP and Rio also have the highest profits and EBITDA, but the growth percentages show FSX and Vale beat them both last year. Earnings per share has Rio and BHP on top, but Vale and BHP have clearly taken a hit, no doubt to the legal issues and settlements they have made for the 2019 disaster. But it looks like Vale are making a recovery this year, and Vale has shown significant growth in earnings. It would be nicer if these companies have quarterly reports, but unfortunately they don't, and I have to work with what I have. Assets show the companies are all relatively stable, with growth in cash and total equity, with Rio taking the lead with cash in particular. However, BHP seem to have weakened their cash position over the last year, which may relate to the settlement they agreed to. But Vale seem to have made a sharp recovery regardless this year, and Anglo are leading in growth. Net income shows a similar pattern, with Rio leading the way, but Anglo and Vale are showing good growth. Liabilities are generally stable, although BHP and Anglo American have all come down slightly, which is good. What really stands out is that Rio, Vale and FCX have been buying back their shares in 2021, a positive sign of their health. So that gives us exposure to copper, iron and nickel. But I think we can do better. Now, as we've gone over the previous two companies, one name keeps popping up because of their strong fundamentals, and that's Anglo American. Now, if we look at their production, we can see that they are well diversified and performing consistently high, with some impressive numbers in PGM and manganese, the metals which stand to make the greatest gains. So who are they? Well, Anglo American are a British listed company who operate in 45 countries, including Africa, Asia, Australia, Europe, North and South America. They have two South African subsidiaries, Anglo American Platinum and Kumba Iron Ore, which have been generating impressive platinum and iron materials, respectively, making them the world's largest producer of platinum with 40% output. They have been selling and moving away from coal assets, and they've moved into modern material demands using smart technology to minimise disruption to the environment, and they boast a culture of care and respect to the areas they work in. In 2008, they spent $212 million exploring 21 countries for resources, focused on underdeveloped and abandoned land. In 2021, they acquired a license to operate in Brazil, where they expected an average 26.5 million tonnes of iron per year, and they've been in operation since 2014. Since 2018, they have been developing their copper mine in Peru, where as part of the project they donated $195 million towards local community projects. Despite the pandemic, they've been able to bring their mines to 95% of production capacity, and they expect their profits to increase in the future due to limited material supply. They also have the Quellaveco copper mine due to come into production next year, which will boost their mined output by 10%. Thanks to strong demand they have been experiencing in 2021, they passed a dividend of $2.1 billion to their shareholders, on top of a special $1 billion dividend, and are putting another $1 billion into buybacks. I'm impressed with the effort the company is making towards working with environmentally friendly practices, how they treat their communities, and their investment into smart technologies. Now, let's just go over the financials. Revenue is on another level, and their trailing 12 months is at their peak, representing year-on-year growth of 37.5%, putting them ahead of Sibanye and Vale. Costs are relative, whereas debt seems to be reflective on the costs and the various projects they are undertaking and seems to be manageable. Profits are also solid, and although EBITDA has come down, net income is at an all-time high, showing tremendous growth. Debt to equity is relatively stable, which is pretty decent given their expensive projects. Assets are up, particularly with cash and equivalents. Equity has been growing year on year. They haven't diluted their shares and have in fact been buying them back year on year. These are solid financials on top of their impressive production numbers, adding more weight to the portfolio choices I have so far, making it free for free. Now, the advantage of having this amount of diversification is that it offers protection from sudden changes in material demands or political economic issues due to having my portfolio spread across different parts of the world. Overall, I should see less volatility. Now back to the production chart, and we can see that this portfolio build is quite comparable to all the other individual companies and only falls behind in copper when compared to FCX and BHP. But I don't want to over diversify, and there are reasons why the least diversified companies can be the most volatile, which I'll explain later. Okay, so we've covered everything about these companies and the financials, so now it's time to look at the metrics. Now for Sibanye-Stillwater, the political situation has scared off investors, but this presents an opportunity to buy at a discount. They are currently selling low at 5.8 times earnings, with the lowest price of sales of 0.09 and price to book of 0.18, along with the other metrics and potential for growth, plus a current 5.86% dividend on a profitable company. They look to be undervalued. When it comes to Vale, they seem to be a good turnaround play, and they're offering a PE of 6.09 and a forward price to earnings of 5.03 and a price to book of just 0.5. Anglo American is trading at 8.6 times earnings with a price to sales of 1.5 and a price to book of 3.78. Is a little higher than I would want on the metric side, but for the amount of growth, particularly with a high manganese and PGM production, I think the stock is cheap compared to the others below. Now, in order to calculate a fair value for these companies and the projection for growth, I weighed in all the information we have so far on production and growth in demand for these companies. Natural growth is a bit cumbersome if we go by their cash flow, but we know their production numbers, which in this industry is fairly representative of natural growth. We can use their sales numbers to calculate the ratio of each material to the company's income. We can then use this calculation to apply the level of growth expected for each material and how much it should affect the growth of the company as a whole. Along with Bloomberg's estimates, I've also gathered worldwide data on compound and annual growth rate for each material to provide more conservative figures, to have a high and low growth range. I'm assuming that sales will grow relative to material demand. And on this basis, we can take the current stock prices and project the future growth. Now for Sibanye, current volatility means nothing to where the stock could be heading over the next 10 years. Now the most conservative growth has the stock growing by 187%, roughly 7.2% per year, whereas natural growth based on past performance would have it grow by 240% or 10.2% per year. Bloomberg's data would have the stock growing by 505% or 19.7% per year. Now we can see that the natural movement of the stock price has fallen in between these estimates, so they don't appear to be too far off. And I would also anticipate that as the demand for more materials increases, these companies will receive more attention and therefore more stock activity. Now if we do the same for Vale, we can see the more conservative growth rate is up by 150%, roughly 4% per year, whereas natural growth rate up by 240% or 10.2% per year, and Bloomberg's data would have the more optimistic of 454% or 18.3% per year. Again, but with Anglo American, we have more promising numbers. The more conservative growth has the stock growing by 166%, roughly 5.8% per year. Natural growth up by 420% or 17.3% per year. And Bloomberg's data 595% or 21.9% per year. Now I think growth at this rate is achievable due to the increase in demand of these materials, but mining companies have been volatile due to various issues, particularly politics, and this week has been no exception. Now, I'm not going to be put off by short-term volatility, as I think this is ultimately a long-term play, and I'm happy to buy in at these levels. But to avoid the burn of market corrections or sell-offs, I'm going to use a dollar cost averaging approach, spreading my investment over an extended period of time, taking advantage of dips to buy in at a discount. Now, I'm going to continue to follow productivity and the reputation of these companies to decide where I portion out my investments. I wouldn't rule out changing to other companies, because ultimately, at the end of the day, it all comes down to productivity and profitability of these companies. For some of you may be wondering why I haven't touched on any lithium mining companies. The simple answer is that lithium is an obvious investment commodity for some time due to its relevance in electric vehicle batteries. However, I found that the companies in this area aren't given out much data on the production reports, and they're quite highly overvalued. They tend to be supplying directly to major manufacturers and various other mining companies directly to Chinese manufacturers. Unfortunately, that makes it very hard to compare them to the same degree as I have with the current ones, and I haven't found anything more than a short-term play. For that reason, I'm going to do more research in this area, and I'll come back to you with a new video once I have something which is a long-term strategy. So that's all I have, and this video actually represents weeks of work, so thank you for watching. Now, as always, if you have any thoughts or suggestions, please comment below, let me know, and remember to subscribe so you don't miss out on future videos and updates. Until next time.